Good morning. Thank you very much for doing this. As usual, I'm going to hand over to you and let you tell us a bit about the fund first, and then we'll get to some questions from the audience.
Murray International Trust is a long-standing trust. It goes back to 1907, and it is a very large, liquid global equity income trust with gross assets of around 1.8 billion. It does have some debt, some gearing. The gearing level at present is around about 6%. And that has been coming down over the past few years as we have chosen not to renew a couple of tranches of debt which were up for renewal again. We were being quoted a rate of 6% when we were paying 2 point something for the previous tranches. So we were in the fortunate position to say no thank you, we'll just leave that for now. The dividend yield is something that people do associate with Murray International, and for good reasons. So the dividend yield currently is 4.5%, and that has been incredibly consistent over time between 4 and 5%, and no matter what's been going on in the backdrop. And the reason we've been able to keep that consistent is partly due to the investment trust structure. So we do have very healthy income reserves. Having the long track record that we have and having the trust being managed pretty prudently over time has meant that we have been able to tuck money away for a rainy day. But we're currently sitting on roughly 73 million sterling of reserves, which is equivalent to 1 year's worth of dividend payments. So a lot of people would give their eye teeth for that. We are very grateful to have that as backup. The trust is currently trading at a discount, as is the sector as a whole. As at the end of the year, which is what this figure represents, it was around 9%. That has come in a bit. It was just under 8% last time I looked. And another feature to remember about this trust is that it's fairly straightforward in the sense that we invest predominantly in equities, listed equities, and there is a small proportion of fixed income holdings at the moment. And we only ever go there when there is extreme valuation attractions around that part of the market. So these are holdings that were introduced 10 years ago at a very attractive level. But again, that proportion has been coming down as a lot of these bonds have been rolling over. And so currently 94% of gross assets in listed equities from around the world. And if we go on to the next slide, this is really hammering home what the investment objective is for Murray International. And we include this in every single conversation with shareholders and potential shareholders, because this is the crucial part of really our message, is to explain what it is. The investment objective for the company has 3 different components. The first is maintaining that above average dividend yield. It's important to our shareholders to have that consistency. And we also want to grow that income and grow the capital ahead of inflation over time. And the objective, it's not listed here, but the goal is to have that income covered from the income generated from our underlying holdings. Now, if that doesn't happen, as I say, we can tap into reserves. That's what they're there for, but that is the goal that we set out to achieve. In terms of how successful we've been in doing that over the years, there's a few bullet points here. So first of all, the chart shows you that above average yield, and this is comparing the yield on Murray International with the average of other global equity income trusts as defined by the AIC. The data on here with regards to dividend growth is a little bit out of date. Apologies, we haven't declared or had accepted our final dividend payment yet for 2024, but the track record stands nonetheless. So we have currently 19 years of consecutive dividend growth. A couple of years before that, it was flat. So it's not that there's been cuts before that, but in terms of growth, we're currently at 19 years. Dividend growth ahead of inflation is something that we've managed to achieve in 15 of the last 20 years. It has been tricky over the past couple of years to achieve that, but the compound annual growth rate on that dividend is 7% over that 20-year time period. And similarly, when you look at the total NAV return over time, we have managed to achieve above inflation growth in the NAV return 14 of the past 20 years, with an annualised return over that time period of 10%. So that's, I think, slightly ahead of a standard global equity index. But the really interesting point is that we do it in a very different manner. The next slide really highlights that point. This is nothing like a reference index. People find it really difficult to come up with an appropriate way to measure Murray International. It's not traditional in the sense that you can just compare it against the MSCI World Index, for example, because the investment objective is not, to beat that index as a lot of other products maybe. And you can see, first of all, NAV kind of consistency over time. So the last few years, it's been, 8-10%. At a time when the equity markets have been all over the place. And so you will see, for example, last year, there was an underperformance versus the FTSE All-World Reference Index of around 11%. Roll back a couple of years and it looked like we were superstars because we outperformed by 17% in 2022, which was a difficult year for global equities. In our view, we weren't fabulous in 2022. We weren't awful in 2024. Every year, we're just trying to meet that investment objective rather than worry too much about what the wider market is doing, because that's why our shareholders are invested in this product. The next slide is building on that slightly. So there is an element of capital preservation in Murray International. It is a more traditional defensive income product in that regard. And although we absolutely want to grow capital over time, it really helps if you don't lose it in the first place, to be quite honest. So if you look at the track record, again, over a long period of time, 20 years, and look at how the trust has performed each month over that time, and you can easily see on average how it's stacked up against in the standard index. So we have, for example, in down markets, a tendency to perform better. So on average, the trust has outperformed by 74 basis points per month in down markets over that period. And the flip side of that is that we tend to participate in up markets, but perhaps not keep pace if markets are very strong. And particularly as we've seen recently, markets being dominated by a handful of companies, which are quite simply not appropriate for this strategy because they don't pay income. And if we go on to the next slide, this really explains and shows how diversified the trust is. So thankfully nowadays, we don't have to be chock full of telecoms and healthcare and staples to achieve the investment objective. We don't have to be dominated by any one particular region or country. We can get exposure from all over the world, and then collectively, as a trust, it's trying to tick those boxes in the investment objectives. So just now, for example, we have 24% exposed to European listed equities. We have 32% in North America, which is the highest it's been for quite some time, actually. People that don't know the trusts would hone in on that and maybe question why it's not bigger. It's just because when you're trying to achieve that investment objective, the stocks haven't led us there. But that's quite interesting to see that weight going up in the US because there are more income opportunities there now than there were, even going back 5-10 years ago. Asian equities, 20%. UK equities have been quite consistent over the past few years, about 6%. And we do have some exposure to Latin America, which again brings different type of exposure and quite unique companies in some sense. And in the sector chart as well, you'll see that we can get exposure to lots of different types of companies, which is fantastic, just from a pure risk diversification standpoint. Top 10 holdings is there for your information. Lots of different types of companies there. You'll see, for example, some of the big tech stocks of the world, Taiwan Semiconductor and Broadcom, are the biggest holdings currently, and we have slashed those positions, believe it or not, because they have been extremely strong performers over the past year or so, but still quite big positions in the trust. And you'll see also things like Philip Morris International, the tobacco company, Singaporean bank in there. CME is a derivatives exchange in the US. We have Grupo Asur, a Mexican airport operator. AbbVie is a US healthcare stock, Enbridge, a Canadian pipeline company. So lots of different types of businesses in there making up the top 10. And you will also see from this chart that we don't need every company to generate that 4.5% yield. We do operate a barbell approach so that we can have really diverse types of companies in there. And so for every, Broadcom, which is really low at the moment for us, just under 1% dividend yield, that's offset by the likes of an Enbridge at 6% yield. And that's always the way it always has been over time. I put in this slide just to give a feel for the kind of trading that we've been doing recently. So in terms of the level of trading, that 13% of gross assets is fairly normal and obviously does fluctuate from year to year. A lot of the selling we did last year was trimming holdings that had held up extremely well. So things like Broadcom, TSMC, and we took a lot of money out of those names because the maximum we can have in any one company is 5%. And so that forces you to recycle that capital into weaker names and not be too, falling in love with any one company or too wedged to any one theme or any one market. In terms of the new companies that went in, and these will be familiar to most people, Mercedes-Benz, we put in last February. Coca-Cola Company was one of our more recent additions, Taylor Wimpey in the UK, and Medtronic, which is a US healthcare devices company. So that kind of broadened the exposure that we had within healthcare. And the divestments for quite different reasons. So Roche and the Swiss pharma company was just kind of lack of conviction. We've got lots of choices within healthcare. This one we thought was okay, but not fantastic. So we decided to get rid of that one. TC Energy is a pipeline company in Canada that we switched into Enbridge. That was an analyst's preference there. China Vanke is one that we got wrong. This was a Chinese property company that we bought a few years ago, thinking that by this time, the Chinese property market would have been cleaned up and sorted out a lot more than it has. So when China Vanke cut its dividends, or cancelled its dividend rather, back in April of last year, that was the catalyst to exit the stock. And Epiroc is a Swedish company. It's a company which does machinery for mining. That was purely on valuation. That had performed very well. It wasn't a big income generator, and we didn't think it had that much more capital upside when we sold out. So that was a divestment for the right reason, if you want. The investment thesis we thought had played out pretty nicely. And where we put money as well is also existing holdings which have been weak. So Diageo is one we've been speaking a lot to shareholders about over the past year or so. We're sticking with that one, have topped it up again recently, for example. And then just to finish off before we go on to questions, if there are any, why invest in Murray International? And I'd say that the main reason you would is if that investment objective is something that you fancy, basically. This is a company which is quite simple in its investment objective. It is about growing that dividend, growing the capital over time, and having that consistency of income. And that is something that often people use as a nice alternative to other global equity income trusts out there, which perform very differently, have very different holdings. We don't have any Mag 7, for example, in here because it wouldn't fulfill the investment objective. So as a balance to other trusts, it can be useful from that perspective. And we also absolutely stick to our guns. So as I say, over the years, it's looked like we've been crazy doing this. Other years, it's looked like we've been really clever. But it is just absolutely sticking to what we tell shareholders we're doing, because the investment objective is set by the shareholders. And it's up to us to try and fulfill that. And I think we're very fortunate to have the whole world to choose from. And when we speak to our colleagues who manage other income products, but they're more constrained to regions, it just makes me very lucky that we can go where we think we can add value, no matter where the company happens to be listed. And with that, I'll finish off. Thank you for listening.
Thank you very much for that. That's good. We have got some questions for you.
Oh.
So where should we start? Let's start with the bond stuff actually first, because that is different, and it's something that very few other funds do. So
yes, at the moment,
what sorts of bonds do you have in there?
Holdings, and they're all emerging market debt. So this is across a whole range of different companies. So for example, we have a couple of Indian corporate bonds. We have some Mexican bonds. We have one South African bond in there. And the individual weight to each of these is fairly small. So compared to what we have in equities, where we have, typically minimum 1%, minimum 5%, the bond holdings are much smaller in size. And again, this is not a call on bonds. It's not a call on emerging market debt. It just happened to be that if you roll back 10 years, these, in our view, for high quality corporates and well-funded government bonds, we're looking a real opportunity, and it helped offset what we were seeing in equities at that time, which had much lower yields. So trying to just use that flexibility as a way to deliver the mandate has worked over time. And currently the running yield on the bond portfolio is around 8.5%, 9%. So it does help to deliver the investment mandate. But would we add more to that category now, or more to other bonds? No, because we're kind of in no man's land with regards to valuations, I think. So it's something that we will use, but we've only really used it in a sizable way twice in the last 20 years. You have to go back, another 10 years before that, before we had sizable holdings. And then it was treasuries and it was gilts, because, again, what they were offering from an income perspective was relatively attractive at that point in time. So it fulfills its purpose, but it's not something that we're banging the table about by any means. It's there as an option.
Sure. Yeah. And then in terms of the credit risk of those, are they relatively high quality companies?
Specified this. We don't do that independently. So myself and my colleague Martin Conahan, who are managers of Murray International, we absolutely lean on our emerging market desk experts in London for this part of the portfolio. So they're the ones that know these things inside out. They go through in fine detail exactly how creditworthy these companies are. But when you've got something like a Valley bond, for example, in the trust, I mean, we actually sold that a couple of years ago. It was trading at 140. There's a par bond. If you already hold the equity, you're happy with the equity, and you're getting what we consider to be really, attractive opportunities in the bond of that same company, and then I think it is worth consideration. But yeah, of course, you have to be careful, and we have to rely on their expertise in that regard.
And then at the moment, the gearing and the allocation to bonds are roughly matched. Is that a deliberate thing?
It's a bit of a shame, because people if they weren't having a conversation, would easily make that conclusion. You're taking debt on to buy bonds, and it's not at all. And so we have, as I say, had more debt as well in the past. So the bonds and the gearing has come down at the same time, which again could be a bit misleading. But it's a completely different decision. It's just you're taking on gearing because you think you can make money on that for your shareholders, but where you decide to allocate that could be equities, could be bonds, could be any location. So it's not tied in.
Okay, that makes sense. Yeah. And then in terms of the gearing that you have got, is it sort of quite long term, or is it
long term? So we have currently 110 million, roughly split in two. One's 50, one's 60 million. The first tranche of debt comes up for renewal again in 2031. And the second half in 2037. And the weighted average coupon we're paying on that is 2.56%. So, I mean, it looks amazing now. And I remember when we took out that longer tranche a few years ago, it was 15-year money. We took it out, and the rate on that was 2.83. And I remember sitting in the board meeting and we were debating, that's a wee bit more expensive than we had been paying. Is that a right decision? And I'm so pleased that the answer is yes, because that's fantastic. So we don't have to think about that now for quite a long time, but we do look, if things change and we are getting more palatable numbers coming before us, there's nothing to say we wouldn't go up again. The maximum we've had is 200 million, so I don't see us going above that. Again, it's a board decision. That would be kind of comfort level, I would say. 110 at the moment is where we stand, but as I say, we don't have to think about it for a while.
Fair enough. Now, I think one of the most important things that differentiates you is this consistency on covering the dividend, because obviously the big other trust in the sector pays income out of capital. So how important do you think that is to generate the income that you pay out?
Level of comfort that you don't otherwise get. So if markets keep going up and up and up, which a lot of people even nowadays think that's a given, it's not a given. So I think just having that ambition to cover the dividend just makes this trust different, makes it clear what it is. And then if we get a bumper year and we can tuck reserves away and we did have to dip into it in COVID, and that again is quite comforting for people. So could we have, a higher dividend if we use our capital reserves? Absolutely, we could have, but that to me would really mix the messaging. And there's, as you say, there's plenty other alternatives. If that's what people want to do, or they want to kind of split the allocation. So I think in our minds, we know at the start of every year what income we have to generate to be able to cover that dividend. And it's not that we would ever do anything solely with that in mind. You've got to have the companies that you believe in. You're looking for that capital growth as well. But again, I actually quite like that discipline of having the ambition of having a covered dividend from day one, and it does sit well with their shareholders.
Thank you. Now let's look at the geographical split again. I mean, I suppose then the other interesting thing, big differentiator, is this weighting in North American equities, which is a lot lower than the world index. And a lot of people are saying that North America looks expensive. Is it driven by valuation? Is that the main reason why you've got
for a long
ratings?
time it was driven by the income. We just could not get the income. I mean, if you go back, let's go back a while now, but it's kind of 2010, I think we had 7% in North America because you just could not get that level of income that we required. Nowadays you can get contributors from there, which is fantastic. But if we were to really push that, again, trying to cover that dividend in a sensible way would be really difficult. So you end up with double the weight maybe in your tobacco stock or whatever, which again doesn't really sit well. So it's actually 32% in North America, 5% of that's Canada, so it's even lower if you're looking just at US stocks. It's not something that we would worry about terribly. If you were to get a lot of US companies up in that dividend, nothing against having more there. Like the last 2 editions actually were Medtronic. So yeah, we can see opportunities there on the income side. It fluctuates as well. It's been interesting over the years when we first added Broadcom, one of our biggest US holdings, and that was 4 years ago, in the dark days of COVID. That was on a 7% dividend yield. I mean, you would never believe that now. It's one of the kind of growth EI darlings of the world, and it's less than 1% dividend yield. But that wasn't that long ago. That was a really interesting dividend. So who's to say that won't come again, and we'll find opportunities. I think the US market is so warped at the moment because of these massive big companies that just do not pay income. They've or very little, no intention really of growing that income. So it's quite an easy call in a way for us just to not bother, with those in particular names. You can get similar exposures elsewhere. So it's not that we're against any of these businesses, but they just don't fulfill the mandate. So we can quite easily pass and move on to something else.
Obviously, US politics is nevertheless dominating the headlines. So there's a question here about your American healthcare holdings, Kennedy Jr. being the health minister. Do you worry about what's going on? Is there anything that you might change the portfolio because of what the US government's doing?
It's fascinating to kind of listen. It's been really interesting this time round, even compared to Trump's last time in power, to see how markets have reacted or how they haven't reacted to some of these really quite wild and bold statements that he makes. In terms of the healthcare companies in particular, so we have AbbVie and we have Merck within the US, which we're fairly comfortable with both of those names actually. The way he's talking about tariffs on drugs coming into the country, that would maybe impact the likes of a Roche, which we no longer own. But maybe I could see some of these companies being a bit more trying to work out what that means for them. I'm so happy enough, to be honest with you, with the exposures that we have within healthcare at the moment. And it's even some of the other policies that have been bandied about at the moment with regards to tariffs. It is impacting companies like Pernod and Diageo, these companies, European businesses that more so Diageo is selling more into the US. But see, trying to make any kind of call right now about exactly what's going to happen. Is it a threat? Is it real? Is there going to be some kind of deal made? Even Mercedes. I mean, Mercedes is really caught in that at the moment with tariffs all over the world. But there's so many clawback schemes going on that actually the headlines don't necessarily transpire, even if they were going to happen, to be as bad as the initial stock market reaction would suggest. So I think just a time of digestion is absolutely needed, and not just an automatic reaction to some of these, as I say, really quite wild stories that are going around.
How about Enbridge? Because
that's right. So the
pipeline's running through Canada into the States.
And they have come out and said if the 10% on energy tariffs, comes to play, that will be okay for them. So they have done the numbers, and the way their business is structured, they don't think that's going to be something that's going to impact them too greatly. So that was pretty reassuring to hear that.
Thank you. What about renewables? Because obviously we were talking about that earlier, that how cheap they are. Well, in our sector, but is that an interesting
but maybe not
area
in the way people would automatically assume. So we have Total Energies, for example, in the trust, which is over the years been gradually, maybe quite a quiet way, but just doing more and more and more in that space. And I think the story is believable. I think they do need the traditional side to fund a lot of these projects. And I do think no matter what happens in the US, this is definitely going to happen. It's not something that can just stop. And we do have exposure through Enel, which is our Italian utility company. We have Shell as well as the other company, which has exposures to the area. So I think out of them all, Total's the one that actually stacks up, I think, is the best in terms of its policy and its approach to that particular part of its portfolio. And I think it will continue to grow.
Okay, great. Thank you. Asia, I've been writing some stuff recently looking at that, and it's incredible how the yields have gone up.
It's been about
Is
the
that
same,
growing as a
James, to be
proportion
honest
of
with
the
you, over the
portfolio?
last kind of 5 years or so. That Asian exposure has been pretty static. And we have made some changes to the portfolio in there, but what's, again, really quite pleasing in Asia is you can get exposure to so many different kinds of companies in so many different locations, and they don't all act the same way. And I'm really pleased that that has changed even better over the past few years, because at one time with China was down, the whole of, lots of Asian markets were under a cloud as well. That has not been the case. Even companies like OCBC and Singapore, the bank, or SCB in Thailand, they've got nothing really to do with what's going on in China. They've got really nothing to do a lot of the time with what's going on in other parts of the world. So they keep doing what they're doing in their own market very well. And that has been really pleasing from an income perspective in terms of the rewards that they've given back to shareholders in that way. So Asia was kind of there. I think the US is definitely catching up in terms of kind of clocking on to the fact that the income side is valuable for certain shareholders as well. Asia were a kind of step ahead in that sense, and that continues to be an important part of the trust for us because of the diversification it brings.
Okay, thank you. One specific question about, can you explain the difference between what BESI does and what Taiwan Semiconductor does? Because there's a question here about how they compete with each other.
TSMC, so they are linked. BE Semiconductor, they provide the semiconductor equipment. And the exciting part of that business is in a part of the business called hybrid bonding. And it is to do with exactly how it's not glue, obviously, but how they actually come together in a more efficient way. And they're the pioneers in that. Other companies are getting into it now, but BESI were there first. So they sell to the likes of TSMC, so that when they put the semiconductors together and they sell onto other people, they can do it in a more efficient manner. So it's been quite interesting. BESI's a really volatile stock. You have to kind of remember that when you invest in this one. It can be quite lumpy orders from the likes of TSMC and Intel and people like that. But so it is linked, but it's not identical.
Okay, makes sense. Thank you. And then TSMC is one of these holdings that we just see at the top of everybody's portfolio.
It's come back
that's
to
not something you worry about.
Why are you owning it? We've held this for about 20 years or something, and we've held it forever. We've taken far more out of the name than we currently have. And you do keep coming back to it because at one time it was more for income. That's what that big yielder back when we first invested in it. And now you're thinking it's not a great yielder. It's done really well over the past year or so. So is it still worthy of a 4% position? What gives me comfort is the fact that they are just so far ahead of peers, and they're still investing so much, billions, to keep that dominance. And they've been quite clever and quite savvy in terms of working with places like the US to get more local production, but they're charging for it. They're not just, they're in quite a powerful place when it comes to negotiation, because these chips, these high-end chips they're so crucial, and they are everywhere. So a company is not going to really go down the quality curve on that aspect. So I think an awful lot of things together I just make it still tick the box. And I mean, it upped its dividend by 30% last year, despite only having a 1.4% yield. So in terms of rewarding shareholders in that way, that's in the mindset. That's not something that you're having to kind of persuade them to do. They're already there. So it's still, as a company that fits the mandate. And yeah, it is a very, very popular stock. So that's not one that we think we've got really any huge differing view to others, perhaps. But I think it is one that's still a really good company. It's cyclical. I mean, 2 years ago, this was one of the worst performing holdings. Again, you have to accept that. It's going to be up and down with cycles, but it's one that I think is still a very good.
These are all fairly big companies. To what extent do you go down the market cap scale into sort of small and mid-cap?
There's a limit to how far down we can go. So given it's a 1.8 billion trust, minimum position 1%, and you don't want to ever be stuck in a stock. So there are limits. One of the smaller ones we've got is Taylor Wimpey, so a stock we put in last September. So I think market cap for that one is about 5 billion sterling, something like that, if I remember correctly. So that one, again, that was probably the lower end of what we feel comfortable with and just how it trades as well. So it's not just the market cap, we've got to look at the free float and just its average daily volume, etc. So it's not that we're against it. Bezi as well, interestingly, when we bought that, going back again a few years ago now, that was a kind of €5 billion market cap company. So one that really wasn't on the radar for most people at that time. So you can go down, but I wouldn't say we can really go much lower than that, to be quite honest with you.
Yeah, fair enough. Makes sense. I'm intrigued about Mercedes-Benz. So what's the
so this is one that,
vehicle story
like
with that?
most of the global car manufacturers, have been pulling back from. So as the EV story has just slowed a bit, there's just not the infrastructure that would be ideal for it. The costs are still high for a lot of people. There's still issues on batteries. There's still a lot of work to be done there. There's just the government support, and I think in general people's acceptance of these things has kind of stalled. But the good thing with Mercedes-Benz and others is that because they are like so big, they can flex that model. So Mercedes have like EV and traditional and pretty much every model they do. So they do have flexibility around that, compared to like Tesla, for example, that's just associated with one thing. So that, again, it's quite good that they have the ability to flex depending where we go with that particular strategy.
Obviously, one of the things that's been dominating headlines this week is possibility that the war in Ukraine might end.
No, we didn't.
Did you have any Russian stocks when they invaded?
I've not really gone into this, but there is a quality assessment on every company we would do. There's different components of that. And part of it is corporate governance. That is just kind of the way you would expect that to be very much part of a quality assessment. And looking after shareholders. So no, we didn't, and we've never had any Russian holdings in the trust.
Okay, fair enough. So actually,
I think
that
when
sort of quality thing is important.
You can come at it from different angles, but if you're trying to get a consistent income from a company, that absolutely feeds into how the company's managed, what's its cash flows like, can you guarantee that? You don't want people squirreling away a lot of it for themselves. So it's not to say that you can't invest in family-owned businesses or companies are invested in other companies. That can be absolutely fine, but you've got to get to why it's being done and do you feel comfortable. And we only have to have 50 names, so it's not like you're having to agonise over these decisions. If something is a bit off, you just really don't need to go there. And we have the whole world, as I say, to choose from, so we have maybe a bit more flexibility than others over a lot of these things.
Cool. We always get this question.
Yes, I am.
Are you invested in the trust?
Yes, we don't have to, but yeah,
and
I think it makes sense
team
that
too,
if you manage this, and that this is the only thing I manage as well, which I love. At one time, I've done small cap over the years. I've done equity funds without the income element to them, but this really does appeal to me just as a person, as an investor, and as a manager. So I'm well aligned.
Brilliant. Thank you very much indeed, Samantha. I think we covered a lot of ground, and good luck with it all.
Thank you.
And great. So thanks for everybody to tuning in today. We'll be back next week talking to the manager of Hydrogen One Growth, which had a little bit of good news this morning. Bye.